Welcome back. Let's talk about the markets as we speak. We're almost at that 18,300 mark. It's a steady session, but pretty quiet, just a gain of close to about 0.2%. But what do you do from here on? What is the positioning in the market? Vinod Karki, the head of strategy research at ICICI Securities, is now joining in. Vinod, morning. The overall global setup appears to be improving or stabilizing at least. Commodities have seen a decline, whether it's base metals or even crude prices are now at $87, $88 per barrel. The earnings picture has not been bad. Financials are showcasing the best return ratios in close to about a decade. Is this all priced into the markets at 18,300, or do you see a lot of upside from here on?
Yeah, thanks, Rima. So I think if you remember, the market was significantly lower at the height of this, when the Ukraine-Russia conflict and inflation was spiking significantly. And there were talks of the market going even below, below those 16,000 levels. But from there, we have seen a bounce back. What is happening is market is reaching a fair valuation kind of environment right now. Because the big thing that has changed since over the last 6-7 months is that we were talking about a 60s to 80s kind of a spike in interest rates in the US. So that scenario is slowly fading out, where now the inflation number seems to be peaking out, and there are talks that the next year, the Fed will be in a better position to slow down and even cut if we at all fall into a recessionary environment. Last year, the problem was that the Fed was at close to zero rates, and there were chances of a recession already, basically. So there was no ammunition with the Fed to fight any kind of a significant slowdown, if at all it came by. But now, with terminal rates at 4.5% to 5% after the few hikes that they might do further, the Fed will have enough ammunition to cut rates if at all we get into from inflation to actually sharp fall in inflation and recessionary kind of environment. So I think from an equity valuation perspective, this change in environment puts a floor on valuation, which had seen a significant contraction because it's a direct relationship. The rates go up, the equity valuation starts contracting. So that contraction in equity valuation environment is slowly fading away, in my view. So that sets a floor for valuations. But having said that, the movement in market prices seems to suggest that we are reaching a fair valuation, and further increase in stock prices will be only driven by earnings growth, whatever they come by, the double-digit, mid-double-digit or something like that. So equity valuations equity prices could follow earnings growth from here on. I don't think there is a scope for valuation, either contraction or expansion at this point in time.
Okay, got that. I also wanted to talk a little bit about some of your stock ideas. You are very bullish on your top stock picks include names like Ashok Leyland, there is Ultratech Cement, there is Sapphire Foods. A lot of these are the domestic consumption plays, right? Whether it's auto, whether it's QSR. Do you think this is the way forward? As a part of your portfolio, is it prudent to sort of be bullish on the domestic consumption story?
Yeah, if you look at our orientation, we are more bullish on the domestic investment cycle and the credit cycle, along with a bit of discretionary consumption. So what is coming out clearly is that the whole GDP expansion is being led by the investment cycle, and now we are also seeing credit cycle pick up along with industry credit picking up. And the consumption basket, if you see, it is getting into a dichotomy where high-end discretionary consumption is showing very robust patterns, whereas the mass consumption categories are showing sluggish, kind of demand. And it has to do a lot with the income profile of the people who consume these products. So that's where the dichotomy is coming from. So broadly, if you look at where the demand is arising in the economy, it's largely from the investment side of the economy, be it construction, the whole real estate cycle, the power utilities, now telecom also looking good after the recent tariff hikes, that they will be able to invest. And metals and commodities, others had already announced a lot of investment activities, while the investment in digital infrastructure, equipment, and all, we are seeing a lot of announcements anyways. So I think it's a broader investment cycle which is picking up. Initial signs are only through the announcements that we have heard. That the conversion from announcements to actual flow into the balance sheets and cash flows of companies, order books, and all will take some time. But it's showing up in terms of industry credit picking up after a decade, and a lot of things. The real estate itself, which is a significant part of the gross fixed capital formation, showing traction. Yeah.
Vinod, do stay on. Need to get into a break. We'll come back and continue this conversation. Welcome back in conversation with Vinod Karki of ICICI Securities to talk about the markets and the way forward. Vinod, once again, now the debate has opened up whether we should be investing in equity markets per se, because debt as an option is also turning out to be fairly lucrative. As you said, valuations have reached fair levels. There perhaps cannot be much upside in terms of a valuation re-rating. Now that return ratios on the debt side, fixed income is getting better, would you recommend allocating money to debt over and above what you're doing in terms of equity, or take away some of your equity investments and put in debt now?
Yeah, from a asset allocation perspective, it's a good signaling that if equity markets start reaching fair valuation and bond yields are reasonably high, it's a natural asset allocation that you start moving some of it to debt. So I don't think that would be a very that would give you any bad outcome. But as we have seen, in an environment where the economy might be driven by investment and credit cycle, some of these, these cyclical companies can significantly outperform, so from a portfolio orientation, if you move towards those kind of stocks, you could get much higher return. But on an overall market basis, where the defenses won't do much, the expensive, low volatility quality stocks might not do much outperformance. Overall, I think there is a good scope for this kind of asset allocation to do, basically, as we reach more than fair valuation.
Okay, all right. We'll leave it at that. Thanks a lot, Vinod, for joining in, and have a great day. That's the word coming in from ICICI Securities. We leave the markets absolutely quiet. Nothing much has happened since we started the show. But don't go anywhere. Halftime report is coming up next. It'll take all the market action for you.